And one of the interesting things that came out of that was really that the mortgage business in the US is very government centric and structured, right? Basically, everyone is selling the kind of conforming products, right? And those are great products for most folks, but one of the things we kept seeing in the data over and over again is that first-time buyers in particular are being left behind, right? And are struggling to get into the market. And if you look at the last couple of years, in particular the last 2 years, that's gotten a lot worse, right? And so I sold Nomis 2 years ago and then started the company that I'm running now called Ownify.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Today, we have the pleasure of speaking with the CEO of Ownify. It's a venture-funded fractional homeownership platform. This conversation, we're going to break down what it looks like from a few different perspectives. From the home buyer, these are like first-time home buyers who are able to make cash offers working with Ownify. I love this. And have fractional ownership. We're going to break down what that LLC structure looks like, how he's doing this, how he's managing the administrative side of it, as well as what's it look like for the investors. The investors are seeing a target of 15% IRR, which he said he's beating that currently, and a 1.7 equity multiple as well too. Now, these are just projections, but at the same time, look at the idea of this scenario, helping first-time home buyers own homes and get past the affordability of those issues. Currently in the state of North Carolina, this is where Ownify is launched. So let's take a listen to this conversation. Everybody, please welcome to the show Mr. Frank Rohde. All right, the time has come. Frank Rohde, welcome to the show. How does it feel? First of all, where are you coming from today?
I'm coming to you from my basement in San Francisco.
San Francisco. Always love the weather chat. How's the weather out there? It's still early morning while we're recording this, right?
It's actually really beautiful today. It's one of the rare days where it's sunny and warm and the fog hasn't come in yet. So,
oh, wow. Wow. Very cool. I don't know much about the fog. I do know about sunny and warm. It is that as well here in the Carolinas. Recording this here early kind of springish time, and man, things are swinging, things are booming, everybody's happy. Well, for the most part, everybody's happy. And we're going to talk a little bit about real estate today, right, Frank?
Yep.
And the two of us are not doctors, and here we are in the Real Estate Mogul MD. But the cool part of that is we've got the first part, right? We've got the real estate part. So if you could let the listeners know, Frank, just a little bit about your background, your history, professional history, kind of where that's led you at and where you're at now.
All right. Yeah, thanks. First of all, Brett, thanks for having me. Excited to be here. Where do I start? I mean, I was born in Germany and I grew up there and lived there until I was 18, 19, came to the US for college, went to Penn. I did the Wharton undergrad program there, then moved to the West Coast where I've been ever since, and spent a couple of years in consulting, financial services. I started an insurance company early on, then spent a couple of years at FICO, getting into credit risk underwriting and some of the software that banks use. And that led me to start a company called Nomis Solutions, which I ran for about 15 years as CEO, and eventually sold it 2 years ago. And that company built the pricing engine for a lot of the large mortgage lenders in the US and Canada, Australia, the UK. So I got really deep into mortgage pricing and mortgage math, right? Spent kind of 15 years in the bowels of that. And one of the interesting things that came out of that was really that the mortgage business in the US is very government centric and structured, right? Basically, everyone is selling the kind of conforming products, right? And those are great products for most folks, but one of the things we kept seeing in the data over and over again is that first-time buyers in particular are being left behind, right? And are struggling to get into the market. And if you look at the last couple of years, in particular the last 2 years, that's gotten a lot worse, right? And so I sold Nomis 2 years ago and then started the company that I'm running now called Ownify. And Ownify is really an alternative path for first-time home buyers to get into the market. And what we're doing in a nutshell is we're partnering first-time buyers with investors to create fractional ownership structures around single-family homes, around starter homes, right? And so that's what I'm excited to talk about, and what's core to my mission and potentially interesting to your audience as well.
So very interesting. First of all, congratulations on your journey and starting a company as an entrepreneur, right? Building that company, growing that company, and then selling and exiting that company. That is a massive feat in itself. So congratulations on that, Frank.
Thank you.
And I'm so excited about this. And the listeners, I don't know if they've been through a few maybe syndications through underwriting, or maybe they've leveraged capital for their own single family rentals or something like that. The idea of underwriting, I guess, has two ends to it. Two ends. One is you're boring me, you're putting me to sleep. The other end is I'm so excited about this because every single deal that I do when I leverage capital requires this underwriting stuff.
Yep.
And that's where I'm standing right now. And it's very interesting of your background, and I'd love to learn more about this process. And when you built this machine, basically, or were Nomis, correct? That was the company?
The product company, yeah.
So you were with that company when they built this pricing machine, which basically, to me, it's just a program, right?
Right.
Just a program. So simple, right? And
Do it in a day.
yeah, right. But would that then help you as your clients were the actual lenders? Is that how that worked?
Yeah.
Okay.
Exactly.
And they just basically ran scenarios to see risk versus return.
Risk versus return, demand, the probability that you win deals, right? And obviously, and those are all loan products by and large, right? So you always have this trade-off between, can I charge more and get more return? But if I charge more, I increase risk, right? I increase adverse selection, I lower the likelihood of winning deals, I increase my prepayment penalties or potential, right? So there's a really narrow trade-off, narrow band to say, where do I want to be as a lender for a particular loan, depending on the market, the competition, the profile of the borrower. And you have all these data elements, right, that are out there that you can capture and bring to bear on that individual decision and transaction. And so that's what that software did, right? Really trying to understand both the competitive environment and the return to the investor, which was the bank effectively, or the lender.
Yeah.
And then the behavior of the consumer as well, right?
And the behavior of the consumer, once converted, I mean, you're probably running these numbers based off the average length of a loan, or average ownership of that asset. Is that how that would work? Because it's so hard. There's so many variables that go into the projection of, hey, how much money am I going to make, or how much money am I going to pay?
Yeah, I mean, if you think about, these are consumer loans, right, or consumer mortgages, and the vast majority of consumer mortgages don't stick around for 30 years. So you have this nominal product with a 30-year amortization, but really the consumer holds it for, on average 4.5, 5 years before either they sell the home and move somewhere else, right, and the mortgage gets repaid, or they refi it in a declining rate environment. So really the math is all about what is the projected term, the actual term that the consumer holds the product, and therefore, what are the cash flows that, as a lender, I can collect. But I think one of the big things we learned, right, looking at mortgage lending and how it helps the first-time buyers, that first-time buyers in the U.S. today are really struggling for a couple of reasons. And one big one is the down payment, right? So you need 10% down payment. And in some markets, 20%. If you show up with a low down payment product, like an FHA mortgage or some other, low down payment solution, a lot of times sellers won't even consider your offer, right? So you're getting outbid in the market. First time buyers are struggling with the monthly payment, right? Because mortgage rates are high and home prices continue to go up. So the affordability itself has gotten much, much harder. You have more student debt, right? Despite what the government is trying to do, you've got a ton of student debt out there that is weighing on the budget of first-time buyers. So you have folks who, might have enough income, but they're paying $500 or $1,000 a month in student loans. And that weighs on their ability to afford mortgages. And then, especially for first-time buyers, you now have basically a tax policy where, if you're making $100,000 as a young couple and you're looking to buy a $400,000 starter home, you're not itemizing your taxes. You're taking the standard deduction. So this benefit that used to, support homeowners through the mortgage interest tax deduction really doesn't help you anymore, right? And so all of these things have come together. And we could see that in the data where, first-time buyers are just struggling. And you probably hear this anecdotally, right? In your circle of friends and folks you talk to, it's like, well, it's getting tougher and tougher, right? I know it's the case in Charlotte, it's the case in Raleigh, Durham, the Triangle where we launched, right? Nashville, no matter where you look, it's the same story. And so that was really the genesis of starting Ownify, to say, is there a path here where we can structure an on-ramp for first-time buyers that doesn't involve debt, that actually looks at the home as a true investment opportunity without, a mortgage, without debt, and gives the first-time buyer the ability to purchase their home in that fashion, right, as equity.
Very interesting. So what does this look like then, Frank? I'd love to take two perspectives here. One, for the home buyer, right? I'm noticing that it says buyer, not home owner. So I'm wondering how this equity layout works. Mm-hmm. So what does this look like, say, for that couple that you said maybe making $100,000 a year and purchasing a $300,000 or $400,000 house? How does that work? Walk us through that quickly.
Yeah. So the way that works is that, and this gets back to your point, Brett, about underwriting. So the first thing is we qualify the home buyer. We call them the ONI. And that's an ONI. Oni. Yeah. Ownify, and our customers are Onis.
Oni. Okay. I thought you were calling them homies. I'm like, oh, that's a whole new brand right there, Frank.
No. I think you're gonna run into trouble with that, right? Yeah, so right. Oni. We're turning you into an owner. And so on the journey to that, right, you're working with Ownify. So the way this works is that we qualify customers, and we've built an underwriting engine, and that's where the FICO background and the Nomis background and all that came in handy. But if you go to ownify.com, you can qualify yourself into effectively a purchase budget, right? That says, congratulations, Brett, you're qualified for a $400,000 home. That's based on your credit, your income, your free cash flow. We do a thorough, free cash evaluation. And so far, the portfolio of Onis that we have has an average FICO of 740. They've never missed a single payment, right? It's been 100% occupancy, zero vacancy. So, we're trying to build a very, very pristine portfolio of customers. So once you're qualified, let's say for a $400,000 home budget, we partner you with an agent and you go out and shop for a home. And generally, these are starter homes, right? So think 350, 450, maybe up to 500. That's the sweet spot for most of the transactions. And once you, as a customer, find a home with your agent, you submit that to Ownify, and we underwrite the home. So we have another underwriting step, which is the asset valuation and underwriting. And a lot of that is based on, third-party data and AVMs and, things we can pull on the home itself. But we also do a thorough physical inspection to say, yes, this one meets our criteria, or no, this one doesn't. So it's really a two-step process where we underwrite the customer and then underwrite the home to put the two together. So then you ask, what does that mean for the home buyer? For the home buyer, there are really three agreements that run in parallel. The first one is what we call an equity share agreement, where the home buyer on day one puts down 2% of the purchase price of the home. And that 2% buys them 2% of the membership interests in an LLC that holds title to the home. So limited liability company. And that LLC issues 10,000 shares on day one. We call them bricks, 10,000 bricks. The customer buys 200 or 2% of those bricks and signs up for an equity share agreement where over 5 years they buy roughly 13 bricks or 13 basis points of the equity of the home every month. And over 5 years, that 13 bricks per month gets you to 1,000 bricks at the end of 5 years, or about 10% of the equity. So that's the first agreement. The second agreement is a long-term lease. It's a 5-year lease agreement that establishes the occupancy rights for the customer to say you're living in the home and the rent you're paying is the rent for the bricks you haven't bought, right? So if you think about that, the rent that the customer pays actually goes down over time, which is attractive because most of the time, rental agreements, rent goes up over time. So you're paying rent over 5 years on the bricks, on the portion of the equity that you haven't purchased. And then the third agreement is a purchase option, which allows you as a homeowner or home buyer to purchase the remaining equity that is held by investors at any point in time. And so that's a call option effectively. However, the purchase price is at the then current market value. So if you think about those three agreements running in parallel, really what we're doing is we're saying to the customer, you can live in the home and you can buy your home brick by brick, right? With this purchase plan. You're building equity over time. You don't need to ever buy 100% of the equity. You can stop after 10%. You can keep going and renew and go to 20% if you want. Or if you want to own the home the traditional way with a mortgage, you can do that at any point as well, right? And go out, get a mortgage, use the 10% equity that you've built up with this program as the down payment. And then you're buying the home in a non-competitive purchase from Ownify, from the LLC, right? And so the crux and underlying all of that is that we value each home once a month, and therefore we value each brick once a month. And bricks trade, i.e. are sold to the Oni and are sold to investors at the current market value. So if home prices go up, that benefit accrues to both the Oni and the investor. If home prices fall, right, both Oni and investor are in the same boat and are sharing in both the appreciation and potential depreciation in the home. The Oni builds up, from 2 to 10% equity over that 5-year horizon, and the investor effectively holds those bricks during that period. So for the home buyer, it's an attractive on-ramp, right, into ownership. For the investor, it allows the investor to participate in the appreciation of an owner-occupied single-family home. And what's attractive about that is that we've seen over the life of the fund and the life of the portfolio that we've had, as I mentioned earlier, 0% vacancy. We've had 0 late payments, and we've had about 60% lower repair and maintenance cost compared to single-family rental industry averages, right? And the reason for that is that the people who are living in these homes, which is why we call them Onis, are acting like owners rather than renters, right? They're fixing the home, they're painting the walls. We've had someone, renovate and redo the floors, and that's all good for the property value, right? And ultimately accrues to both the Oni and the investor. And so what we've built with this structure is an investment vehicle, right, that allows investors to come in and participate in the appreciation and then obviously the rental income of single family homes for what is effectively a 5-year hold period.
Wow. There's a lot to unpack. It makes 100% sense to me, and I got a ton of questions. So that is a very interesting approach, that fractional ownership and setting up the LLC for that property. In my mind, it seems chaotic from a management perspective to have an LLC. How many assets are currently in the portfolio?
So we have 6 today. We're working on our 7th this week.
Okay, so you're relatively new.
We're relatively new. We started about a little less than a year ago in the Triangle, right? So we've got our first couple of buyers in Charlotte looking at homes. And so we're going to be at, 40 to 50 by the end of the year.
Okay. So from 6 to 40 to 50, each LLC has it's a business. So I'm just thinking of the administrative joy of keeping up those businesses, and each LLC has its own bank account then, correct?
Mm-hmm.
Oh, wow.
But if you think about what all that is, it's just software. Uh-huh. It is a set of rules and a set of, execution steps that you can by and large automate. So, starting an LLC with this structure that we've built, which is a series LLC under Delaware law, takes us about 5 minutes, right? And, creating the reports, creating the bank account, creating the annual filings, creating the tax returns, all of that is automated. And that's core to the software development we've built. One is the underwriting, and then 2 is the back-end ledger to be able to administer the LLCs and each of the investors in that LLC, right? And the equity share. And so, yes, you're right. On the surface, that is complex, right? And it requires a lot of automation. But the benefit of it is that you can give the Oni true ownership, right? It's not a shadow savings account where you're asking them to rent and give you money that you put into some sort of, savings account. It's actually, they're buying membership interests, right? The bona fide shares in a company that owns title to their home. And that's attractive, right, to the customers.
When you're underwriting the value of the property, so you're pulling in, creating basically AVM, these computerized market value. And as much as we would want to think that market value is objective, it is subjective. It is. And like especially, I feel like a lot of times I go into battle when I go to get a mortgage. And I'm a property, it's the bank or it's the lenders. It's in their best interest to reduce their risk, to reduce the value of the property, reduce the LTV, that kind of scenario. And I always feel like I'm in a battle doing that. But in this AVM creation thing, so it good or bad, but it's equal. I like that it's fractional for the Oni and for the investors as well too. Are you pulling information from CoreLogic to do that?
We don't use CoreLogic today. We use a couple of other providers. Okay. We use Cocoon, Clear Capital, and House Canary for AVMs valuations today. And, it's interesting when you think about this AVM, process and say, is it 100% accurate? And the answer is absolutely not, right? They jump around, they bounce up and down. Sometimes one of them is different than the others. You've got outliers, you've got all sorts of stuff, right? There might be 3 homes that sell in the neighborhood, and all of a sudden, all of the AVMs bump up because by and large, they're looking at historical comps, right? To say, here's this 3-bedroom home in this particular neighborhood. Let's look at all the other 3 bedrooms and maybe the 2 and the 4 bedrooms, and they adjust. But I mean, you know how those work. But yeah. So they're never 100% accurate. But what you got to keep in mind is we're selling equity. We're selling 13 bricks out of 10,000 bricks in any given month. So out of a $400,000 home, right, we're selling $600 worth of equity. And if that valuation is a little off to the high end or a little off to the low end, over 60 transactions over 5 years, that kind of washes out, right? And it doesn't really matter because at the end of the day, you always end up at roughly 10% equity. And so the fact that we're trading bricks back and forth at the same valuation makes this really fair. And the fact that we're using a third party, so far we've not had any arguments with our customers because they look at it and go, okay, it's not you guys coming up with a valuation, right? And then telling me you have to buy it at X. It's defensible third party mechanism, right? That you use. So you don't have to be 100% when you're selling, 13 basis points every given month.
Yeah.
As long as you're, directionally correct.
Yep. Interesting. The other thing that I heard you say too, Frank, is that you assign them an agent. What are the pros and cons versus, having your own agent as an prospective Oni?
So we do both, right? Some Onis come in with their agent, or the agent heard about us. We've had that a lot where agents call us and say, I've got this customer, maybe they have an FHA mortgage or they haven't qualified for a mortgage. They want to buy a house. Can you help them? So agents bring in customers, or a customer comes in because they've heard about us and they bring their own agent, and that's fine. We then accredit the agent. So there's a section on the Ownify website that is specifically focused on agents and their accreditation process, right? So if you're listening to this, you're a real estate agent and you say, I want to represent Ownify in Charlotte, right? Or some other market, you can do that. And then we also have agents, right? That where someone comes in as a customer and they don't have an agent, we will partner them with, our preferred agent in that particular market.
Nice. And then on a, insider track, do you have licensed agent inside of your company so you're getting referral commission from that as well too?
We are licensed in North Carolina as a real estate brokerage, yes. Yeah. So we can get
nice vertical. Yeah, nice vertical. Yeah. And then so from the investor perspective here, I heard you say fund. So that LLC is, I guess maybe I may be explaining this wrong, but that LLC is basically the fund where you've got this pool of capital. You're deploying this capital on these approved assets, and you're not leveraging any debt beyond that. The money is coming directly from the fund, so it's sitting there as deployed cash, basically.
Almost. Pretty close. Yes. The way it works is that the fund, so the Ownify Home Fund, that's where investors put capital in. That fund invests across all the LLCs in a diversified fashion. So if you're investing in the Ownify Home Fund, today you're buying effectively membership interests across 6 and then 7 and then 8 and then 10 homes, right? And so part of the logic here is that as an investor, I don't necessarily want to invest in a single home. I want to invest in a diversified pool of homes, right? Because something goes bad in one home, right? It doesn't tank my investment returns. I'm diversified. So that's one benefit. The LLC structure for each individual home is really for the benefit of the individual owner to say, I have I don't, as an owner, I don't want shares in the fund. I want shares in my home. I want the feeling of I'm owning and building equity in my own home. I'm buying bricks, right? And the fund kind of fills in the balance, right? And the reason we've structured it as a fund is one, diversification for the investor, and two, the ability to manage the sale of the bricks back to the owner over that 5-year horizon. And so for an investor in the fund, the benefits are really, you're investing in real estate. So it's tax efficient. You're getting, your depreciation, coverage on your net income, right? So you're getting depreciation tax deduction. You are participating in home price appreciation as home prices appreciate, right? And you're getting your rental income, on a quarterly basis. So there's a dividend effectively coming out of the fund that goes back to the investors.
Interesting. And if I love the structure just in that series because the control that you maintain, I'm looking at it through the perspective, the investor perspective or your perspective, Ownify, the control that you have, the ability to basically do what you need to do as a manager with that percentage of the ownership. I do like that. And then the depreciation, when you're running just straight line depreciation, bringing it back to the fund then, or are you ever doing like cost segregation? And then what happens on the recapture when the property does sell?
Yeah, so it's straight line depreciation, right? For single family homes, there really isn't enough value in segregation and kind of accelerating depreciation. Most of these homes just don't have a whole lot of complexity to them, right? They're pretty plain vanilla starter homes. So it's straight line depreciation. And yes, when these homes do sell to the owner, which is the preferred outcome, there is depreciation recapture at the end of that period, right? That comes back to the investor.
Mm-hmm. Interesting. Where do you see the lifetime or the life turn of these? Is it, I heard you say that 5-year period. Is that kind of where you're angling, leveraging your experience with the first company that you created, knowing that that's the lifetime of what these investments would be?
Yeah, I think that's a little bit of an unknown, right? I think 5 years is the sweet spot if you think about it from a couple of perspectives. One, it allows the owner to build equity from 2 to 10% without a disproportionately large payment, right? So the monthly payment kind of stays manageable and gets the equity up to 10%. And 10% is really a good minimum to say with 10%, I can get a mortgage. I can use that as a down payment, right? Getting someone to 10% in 3 years is a lot tougher. So 5 years seems to be the sweet spot there. Once you go to 7 years, I think investors look at it and go, that's a really long hold period, right? So we're trying to balance kind of where do we get the owner far enough and at the same time have an attractive investor value prop. That's the 5-year horizon. Now, the way the program is designed, the golden path, if you will, for the owner is at the end of 5 years, you have your 10% equity built up. If you want to buy the home from the LLC, i.e. from the fund effectively, with a mortgage, you can do that. Now, you can also say, I want to stay in the home and just keep going with Ownify. I renew for another 5 years, and maybe I'll continue building equity from 10 to 20% or 10 to 15%, right? I don't really need a mortgage. I'm fine with unlevered appreciation. And that's perfectly fine, right? We keep the customer in the home. And we may put it into a new fund, right, to create some cash return back to the original set of investors. Or the customer can also decide I'm walking away, at the end of 5 years. I want to take my built up equity. And at that point, Ownify will buy it back from the owner but we charge a 2% relisting fee, effectively creating a little bit of a penalty, right, for the ONI to say, I want to sell my equity back to the fund or to Ownify. We will buy it back, but we're charging you 2%. So let's say you've built up 10%, 40,000 of that $400,000 home, we're going to charge you 2%, which is $8,000, and you're getting back your 32,000, right, instead of 40.
How does that work when the ONI just wants to sell? Like maybe they've bought a place in Charlotte and they've gotten relocated in 90 days from the purchase to another branch on the West Coast or something. How can the ONI say, hey, I've got to sell this place?
They can't. So in terms of the operating rights, right, this is all governed through the LLC agreement. The ONI has a purchase.
It's the proportion of the LLC ownership gives you the control of that. Yes.
Yeah, exactly. So the ONI can't sell the home, or they can't trigger the sale. Now, what they can do is they can trigger their purchase option, right? And let's say, as for example, let's say you've lived in the home for 5 years, you've done a bunch of work to it. You've renovated the kitchen, you've put money in sweat equity, and it's worth more than what the ABMs say it is, right? That's great. That's all your benefit as an ONI. So it might be in your best interest to say, I'm going to buy the home, I'm going to exercise my purchase option, and I'm going to turn around and sell it on the open market because I think I can make money that way. That's perfectly fine. What you can do is you can trigger the sale, right? But in your scenario, if someone needs to move to the other side of the country, they can sell their equity back to us, right? And that's the scenario where we will buy back their 10%. We will charge them 2% relisting fee. So they get, a decent fraction of their equity back, and they can use that, as a down payment for another house on, wherever they're going.
And then your target scenario when that happens, when that type of scenario happens, would you then find a new buyer for the home, or would you just go ahead and list it and sell it outright?
I mean, find a new ONI. If you can do that, right? If you can find someone who says, this is a great home for me and I want to buy it over a 5-year horizon with Ownify, then that would be a perfect scenario, right? The other scenario is the one that you're describing, which is you just put it up for sale on the open market, right? And we haven't gotten to that point yet. It really depends on, can you find an ONI fast enough to not have vacancy in that home? At the end of the day, the goal here for us, for Ownify, is not to run a portfolio of rental homes where you have vacancy and, marketing costs and lease up expenses, et cetera. It is really providing that on-ramp to the first-time buyer. And therefore, by design, we always have 100% occupancy rate, right? We don't buy a home until we have an ONI who says, I want that home and I want to live in it, right? And on the day it closes, they start paying rent. That's the perfect scenario.
How do you limit your exposure to an ONI backing out, like at day of close? Like, because your Ownify is signing the purchase sale agreement, right? So you are the one that can be held for, not taking the steps necessary to buy the property. How do you limit your exposure in that scenario?
Yeah, so the ONI puts their 2% down before we close, right? So they put that money into the LLC.
Non-refundable?
Non-refundable. So if they back out for whatever reason, they lose that 2%, right? That's a pretty good mechanism to keep the ONI on track and make sure that this is in fact the home, right? I'm not going to back out. Mm-hmm. Now, is there a risk there? Sure. An ONI could back out and they lose their 2%, right? And we may have put down 3% due diligence money, as you know, in North Carolina.
That's a concept, right? Absolutely.
Yeah. Right. So you might be out, right? But at the end of the day, that's a business risk that is manageable for us.
Interesting. These monthly payments that you're talking about, how does that, say a prospective ONI could have a mortgage payment on the open market with a Fannie Mae, Freddie Mac lender around, say, $1,200 a month or $1,500 a month. How does your structure compare to that payment?
Yeah, I'm just going to look at our website. I think at that level, we're kind of a little above that level in the sense that our home prices start at $250,000. Mm-hmm. And that puts you at roughly $2,000 a month, maybe a little higher. I'm just looking at, so right now, today, monthly payment with Ownify, if you bought a $250,000 home, You put your 5,000 down, that's 2%, right? And then you'd pay $2,070 a month. If you were to get a mortgage at current rates, you'd be at 2158. So we're about what is that? It's $88 lower than the mortgage payment at that $250,000 level. If you go up to a $400,000 home, you do the same math, right? Ownify monthly payment would be about $3,300. Mortgage payment would be about $3,450 at today's rate. Now, the mortgage payment is your principal, your interest, property taxes, insurance, and maintenance, right? And a lot of times people don't take into account the fact that when you're a mortgagor and you own your home with a mortgage, you have to come up with all these payments, including the maintenance and repair costs for the home, right? So we put that allowance into the comparison to say, if you take out a mortgage, that's what you have to budget for. With Ownify, we put all of that into a single payment. So the Ownify payment covers your occupancy, it covers your equity buy, but it also covers property taxes, insurance, and obviously an allocation, right, for maintenance, which Ownify takes on. So there aren't any incremental costs to the Oni, which is why this program is really an on-ramp, right? If you think about it, it's kind of homeownership on training wheels, right? You have a single payment, you know what it is, you're not exposed to any sort of risk, right? The water heater starts leaking and you need to replace it, or your roof needs a patch. We will take care of all of that. And that protects the first-time buyer a bit as well.
Very interesting. So we talked a little bit about the in and out for the Oni. What is it like for the in and out for the investor?
So the attractive thing here is so the fund today is open to accredited investors, right? This is a 506c Reg D fund under the Reg D exemption with the SEC. And, it's investing in homes in North Carolina. So the Triangle, as I mentioned, we've got our first couple of buyers in Charlotte. Those are the two markets. And the minimum investment is $25,000, which basically means you can start investing in real estate at a level much less than if you were to buy your own rental property, right? And the target return is 15% over that 5-year hold period. So about a 1.7 equity multiple. You put in 100,000, you get 173,000, give or take, back over the 5-year horizon. And obviously you're supporting homeownership, ideally in your local community as well, right? Or in a market that you find attractive and that we find attractive, which is why we launched in the Triangle. So for the real estate investor, it's an easy way to get started in real estate investing, generate passive income, right, with a quarterly dividend, generate appreciation of the capital in an asset class that is fairly low risk, right? I mean, we're talking about single family homes in strong markets, and with an entry point that is, I think, relatively attractive compared to trying to do this on your own.
Mm-hmm. That 15% return, tell me a little bit more about what that is specifically.
So the 15% really is a combination of home price appreciation and the annual rental yield, right? And today the annual rental yield falls somewhere between 4% and 5%. So that's the kind of cash payout of rental income that is being generated by the fund or by all the homes in the fund, right? And that comes back to the investor in the form of a quarterly cash dividend, right? That goes back. Either you can reinvest it or you can just take it out and use it as passive income. And then the balance is home price appreciation. And we're expecting between 5 and 6% home price appreciation. That's what we've seen since inception. And then with a little bit of leverage at the fund level, we can increase, we can lever up that appreciation to generate about a 15% return. When we look at where are we today, 2023 results for the portfolio were just shy of 19%. So we're well on track to that 15% target IRR, hopefully coming in, a little better than that.
15% IRR.
Right. So okay. internal rate of return, right, over the 5-year hold period.
All right. Well, very, very interesting. I love all of these pieces. I think you've Spent a lot of time with lawyers reviewing contracts and agreements to get to this point, Frank. Man, my head hurts thinking about it. But no, it sounds like it's very well put together. I like the idea. It's definitely something very new. I love that you're leveraging your experience with that other company that you created, and you saw this place to not only help, but help with a why, help with a passion. I like that. And just a full wrap between the ownies, the investors, and also working with the agents as well too.
Yep. Yep.
What haven't we talked about?
I don't know. I think we kind of covered, there's the value prop to the ONI, the value prop to the investor, there's a value prop to the agent, right? And maybe just double clicking on that, it's as an agent, you get first time buyers who can make cash offers, right? And I think that's really important. And maybe the broader thing, and this is kind of for all three constituencies, right? There's a real benefit to home ownership, right? And you know this, having been in the real estate space, right? It's good for communities. It provides stability. It provides tax base, right? It's good for families in terms of their stability, access to education. And so what I'm excited about personally is, I spend a lot of time and a lot of big chunk of my career helping big banks make more money. And that's all good. But at the end of the day, that's not the core mission that, I want to fulfill. So helping families in local communities, right, make that leap into homeownership is a really strong mission. And that's what excites me about this.
Yeah, that's cool. Well, if you could go back 15 years, Frank, and set beside somebody maybe who was in a similar industry as you, similar direction, whether it was working for bigger lenders or developing your own, being an entrepreneur, developing your own business in this space, knowing what you know now, with the experience that you have now, what would you say to that person 15 years ago that maybe had been on a similar path as you?
I think there's this really interesting saying, which is this question of when is the right time to plant a tree? Well, the right time is 20 years ago and right now, right? And so this notion of just get started with whatever journey you're on, right? Whether it's your personal investing journey, whether it's, your entrepreneurial journey of starting a company and branching out and maybe leaving that big employer to do something. Of course, that's always scary, right? And there's a bunch of unknowns. But the timing doesn't get better. It gets worse the longer you wait, right? And so this notion of just jump in and do it, I think is super important. And, I've had that advice and I've kind of done it, but if I were to go back 15 years and sit next to someone or sit next to myself, that's what I would say. It's like, go branch out on your own, right? It seems scary on the surface, but once you're in it, right? It's super exciting, and building companies, right? Building solutions, trying to innovate, especially in an area as dodgy as mortgages and real estate, right? Can be hard, but it's also extremely rewarding.
Yeah. Yeah. Get started. Keep your head up. Don't get, held down by things not always being what I say, sunshine and rainbows, because it's going to be a roller coaster ride.
Right.
We want to present it on the outside and social media and on podcasts. Everything's beautiful. Everything's working perfectly, but don't hang your head low when it doesn't feel like it's going the direction that you planned or dreamed. Get started, be persistent, stick with it. Things will work out. Let that goal, that dream of yours be the magnet to pull you through, right, Frank?
Amen. You got it.
Yep, absolutely. Well, thank you for your time. Thank you for putting up with my questions today.
No, this was fun. I really appreciate you having me on, Brett. Thank you.
Very, very cool. So if anybody out there, actually, why don't the listeners, when you do get the chance, obviously not if you're driving or anything like that, or maybe when you get home from the hospital, take a look at this website, ownify.com. It's OWNIFY.com. On there, you can see the full realm of what it would look like for Onis, is what I was calling homies, Onis, for the home buyer themselves. If maybe you're in a position where you were looking to buy in Charlotte or, somewhere in North Carolina, you can reach out, learn more about being an Oni there. If you want to invest in the fund, there's more information there as well, too. Or if you're an agent, you can learn more about Frank and his team there at ownify.com. Check it out. And thank you for your time again today and your attention. We really appreciate it. If you have any questions for us, please shoot us an email, info@physicianwealthsystems.com. If you have a chance, leave us a 5-star review, or any star that you want to leave is fine with me. I prefer the 5-star, obviously. And just let us know if you have any guests that you want to hear, anybody reaching out. I always love having great guests, so let us know what you think. We'll talk to you soon. This is the Real Estate Mogul MD.